Registered representatives offer securities through Securities America, Inc., member FINRA SIPC. Financial advisors offer advisory services through Securities America Advisors, Inc. Forest Hills Financial, Inc. and Securities America are separate entities. This is the Keeping Your Money Show with Jamie Westenbarger and Bart Steindler.
Good morning. Welcome to Keep Your Money Show. Jamie Westenbarger joined, as always, by Bart Steindler. Mr. Steindler, how are you doing this morning?
I'm doing great. It's another $1 million morning.
It is 12/8/18.
Yeah.
Somehow those numbers almost all go together and kind of are the same thing.
Yeah. There you go.
Can't believe it's December. The weather outside would indicate it is definitely December.
And that 2018 is almost over?
Well, the way the market went this week, I would say that a lot of people are probably okay with that.
Yeah.
Ready for the new year, right?
No kidding. You know, it's funny because I was talking to someone, regarding their investments, and they had something in their portfolio that matured in 2021. And they're saying, oh, my God, that's a long time. And I go, actually, it's a little over 2 years away.
Right.
It's like, oh my God, 2021, a little over 2 years away.
That's kind of crazy.
It's hard to conceive it.
It is kind of nuts how you think of things in, relative terms. 2021 seems like it's way down the road, but that's because it doesn't seem like 2000 was that long ago, really.
Yeah.
So,
remember when it was becoming 2000 and everybody was worried that everything was going to crash because the computers...
Y2K?
Y2K, yeah.
I was telling my daughter about that the other day, and, she was alive then, but she was a baby, and she thought that was the dumbest thing she had ever heard, that the whole world was going crazy over some code on a computer. So, but
I still, from the New Year's Eve party we went to that year, I still have they handed out mugs that had that Y2K thing on it. It had a little bit more than that, but I can't really repeat that part of the radio. So,
well, I think my mother-in-law and her husband, I think they finally have used up the bottled water, canned beans, and toilet paper they had purchased prior to Y2K. I think maybe earlier this year they had to go buy some of that stuff. So, hey, this is the Keeping Your Money Show, where we cut through all the bulls, the booyahs, the bells, whistles, honks, and horns to get you to the information that actually helps you move towards retirement. We're going to talk about a number of things today. If you miss any of it, you can always find it on our website. You can go to keepingyourmoney.com. You can also find us on all of your podcast favorites like iTunes, Google Play Music, SoundCloud, YouTube, and Stitcher. Just search for the Keeping Your Money Show. We're going to talk about a wiser way to pay taxes in retirement, why considering taxes is just as important as considering asset allocation, 10 smart steps to minimize taxes and penalties on your required minimum distributions, because yes, folks, it is minimum distribution time. If you are 70 and a half or older, remember, got to take that money before the end of the year, or the federal government comes knocking, and they're not nice about the penalties. 401k dilemma. Well, I want to bring you into the loop on what is going on in the 401k world and why some of the advice you could be getting may not be that great for you, because your advisor's hands might be tied in what they're even recommending you do. And then if you're divorced or widowed, here are 5 ways to boost your Social Security benefits in retirement as well. As always, you're welcome to give us a call. That toll-free number is 888-98-MONEY, 888-986-6639. We don't take any calls on the air, but somebody does answer your call, and we'll get you get your information. We got a question for the show. Maybe you want to sit down with us for a free consultation or second opinion. Either way, someone will be happy to talk to you, or you can email me. Our email address is info, I-N-F-O, at keepingyourmoney.com.
Just a reminder that about over a week ago, I think it was 2 weeks ago, the phone number was not working for a short period of time. And so if you did call and you didn't get through, please try that again. We have everything fixed, and it's rolling and working properly now. And we apologize if you tried to get hold of us and we're not able to get through.
Yep, absolutely. All right, so let's talk about taxes in retirement, because there was a good article in Kiplinger's here just this week, written by a financial advisor. I'll give him credit because good for him. His name's Roger Young. but he wrote about the idea that the way you take your income in retirement can really have a big impact on the taxes. And what he talks about is something that is kind of like conventional wisdom. You use up the money in your taxable accounts first, then you take your tax deferred accounts like your IRAs, your 401ks, 457s, 403bs, and finally you tap your Roth assets. Now, we've been talking for a long time about the fact that conventional wisdom in a lot of things when it comes to investments is not very full of wisdom.
It may be conventional, but it's not very wise.
Right. And the reason is because it doesn't take into account, in this situation, it doesn't take into account the idea of taxes. It doesn't take into account what you're really paying in taxes. And he did a really interesting breakdown of someone who had a $750,000 portfolio, about a $65,000 annual spending, and he found that by simply being aware of taxes and being smarter with the distributions, he could take a couple who over 30 years would pay someone in the neighborhood close to $50,000 in taxes and could reduce that, and in some cases may even eliminate most of those taxes simply by deciding properly where to take the money from. And you might say, well, yeah, but you got to take it all eventually. But you have to realize everything is in context. Everything looks at tax rates, Social Security, how much of your Social Security is taxable, not taxable. Like, there's so many factors that go into it. You can do yourself a real disservice by just starting to take withdrawals.
Yeah, and a lot of times we're talking to people who are going into retirement, and I hear this time and time again. It's like, well, I can do my own taxes. And that's true. You can do your own taxes. But are you getting the advice that a proactive CPA provides you when you do your own taxes? Are you meeting with a proactive CPA in September, October, November to plan out what you can do between now and the end of the year to minimize your taxes, and what you can do going forward in the next year to minimize your taxes? That's where the key comes in. And some people look at it like saying, well, this guy charges me X number of dollars a year, and if I do my taxes on my own, I don't have to pay that X number of dollars a year, and I'm retired and I have the time to do it. So, I'm going to save, $400 or $600 or whatever the amount is, and do my own taxes. But in this example right here, the gentleman showed where there was $46,000 in taxes saved over 30 years. Okay, so that's what, $1,400 or something a year in that ballpark.
Probably not paying that for a good accountant. And also the fact that the longevity of their portfolio improved by 8%. Another example he gave, I think, was also showed a improvement in the longevity of the portfolio and a reduction in the taxes. Each scenario was different in the kind of numbers that it had, but by knowing all of these things and by doing it strategically, by drawing your income strategically in retirement, it can make a big difference over a long period of time of the amount of money you're going to have to spend in retirement. Well, and I think it's being aware, of a lot of different things. It's just like when people seek out advice from a financial advisor, it's not because they're not smart. It's not because they can't sit down and learn the same things you and I have learned, Bart, and figure out PE ratios and long-term, growth rates and where the economy's going and build portfolios. And they can. I mean, that's one thing Jim Cramer and I will agree on, probably the only thing. Intelligent people can absolutely manage their own portfolios. The problem is what is required to be able to do that well, most people aren't willing to do. They're not willing to put in the hours of, studying and learning and working and spreadsheeting and everything else that goes into it. We've met a few that have. People have walked in here before, and I'm like, dude, you're doing a great job. You're like, yeah. I mean, you want to pay me to do it, I'll help you. But I mean, you're doing a lot of the work, But those are rare. Those are rare. I think a lot of people that do it themselves think they're one of the rare ones, but you're probably not. You're not really probably putting in the kind of work necessary to be successful at it long term. I would say the same thing about doing your taxes. Can you do your taxes? Sure. Are most of you probably smart enough to learn what you need to learn to do it? Absolutely. Will you actually put in the time, though? Probably not. So, and that's where the real thing is. Does the online software plug in all the numbers for you and everything? Yeah, but you got to tell the software what numbers need to be there. He gives another great example of that, and that is the idea of untaxed capital gains. And you may say to yourself, well, what capital gains are untaxed? Well, depending on your income, can be all of them. So for married couples making less than $77,400, long-term capital gains and qualified dividends are not taxed. Under the new tax code, with standard deductions of a lot more than you had before, you could theoretically earn, $100,000 as a married couple? Take your standard deduction off, and you're not paying taxes on capital gains. So the question is, if you have a portfolio that has a lot of money in taxable accounts and that you've got capital gains you're not going to pay taxes on.
And dividends, too.
Right. Are you doing the calculations on that necessary to determine if that's where the money should be coming from? Because if you're not, you're missing out. You're paying way more in tax. I mean, on $100,000 of income, if you're paying standard income tax on that, after deductions and everything else, you're going to have a $15,000 tax bill. I just told you could take it out and not pay anything. You want to pay $15,000 more in taxes? Go ahead. Or hire a good financial advisor and CPA and, save the money. So a lot of times when people say to us like, I read a book, said if you pay a financial advisor 1%, that's money you'll never recoup the rest of your life. Well, I just showed you they're wrong.
Yeah.
Because if you're taking it out of your IRA, I just showed you by taking it out of your qualified non-taxable dividends, you just save $15,000.
And that's one example of 4 or 5 different things that you could do to affect that tax bill every year.
Exactly. We'll talk about something else when it comes to RMDs coming up next. If you're not taking your required minimum distributions, let me tell you, IRS is going to charge you a whole heck of a lot more than an advisor will, right here on the Keeping Your Money Show.
There's no one-size-fits-all when it comes to planning your future. Jamie, Bart, and all of the advisors at the Keeping Your Money Show understand that your financial goals are unique and your needs are going to change at varying stages of your life. Our team of advisors can help you tailor a financial plan that meets your unique needs. Call us today at 1-888-98-MONEY or visit keepingyourmoney.com to schedule your free initial consultation.